We're here. Anton Stentner podcast number 47. It's January 24th. Sir, we're going to be talking about a $1 trillion commercial real estate crisis.
Commercial real estate is in serious trouble right now, especially here in the United States. And so we're going to dig into the market, why the commercial real estate's in trouble, what we think is happening, the major problem that could emerge, and then also like the opportunity. So commercial real estate is not just in trouble in the United States, it's in trouble globally.
I heard even in Europe.
Even
it's
in
having
Europe,
issues. Already cracks are starting to widen.
in China, all over we have commercial real estate problems. But basically any economy that is shaped like our economy, where they jacked up interest rates, commercial real estate is in trouble. So this applies everywhere, but we're going to talk about the United States specifically because I have no expertise on those markets. The US in particular is the largest commercial real estate market in the world. And since the Federal Reserve jacked up interest rates, it's taken a nosedive of over 11% since March of 2022, according to the IMF. NAREIT, which is the National Association of Real Estate Investment Trusts, they're basically a giant REIT organization. They estimate that the U.S. commercial real estate market is $22 trillion. For perspective, our GDP, like the whole U.S. GDP, was estimated in 2022 to be $25.5 trillion. So realize like our commercial real estate market is basically the size of our economy. It was estimated that there's $1.2 trillion in debt that's going to be maturing over the next 2 years, according to the Mortgage Bankers Association. So that's in 2024 and 2025. And around 25% of that is in these super hard hit categories, office and retail. And so we talked about this for people who need to go review it. We gave the warning flare. The Fed knows this is a problem. We talked about it in podcast number 46. We also talked it in podcast number 44. So if you're one of our regular listeners, thank you for being a part of this with us. If not, please like, subscribe, and leave your comments on this one. This is parts of this. We're going to kind of give an overview of how commercial works. Then we're going to talk about the problems that we're facing. Then we're going to get into, hey, what should you be doing today?
Before we move on, and I'm sure you're going to answer this later, 2 years, things are going to mature. There's a high likelihood that certain people, last name starts with P, are looking at this, and it might influence their timing on decisions they make.
That's exactly one of the thoughts, is that Papa Powell, based on the totality of the data, is going to look around and say, you know what, we cannot have this commercial tsunami, and we might need to stamp this out before it becomes a major problem. Because 1.2 trillion is large enough to create a systematic problem. That doesn't mean all 1.2 trillion is going into debt. It just means 1.2 trillion is maturing. But if it's maturing, we know it was originated when that debt was 3%, 4%. And today, that commercial debt, if they were to get it, is going to be anywhere between 6 to 8.5, depending on the borrower and depending on the amount of equity. That's a problem.
All right, so let's get into how does commercial real estate work as an asset class before we get into kind of how this is going to affect investors.
Bingo. Yeah, so how commercial real estate works as an asset class is, first off, we have to understand there's just types of commercial real estate. And so when we say commercial real estate, people don't really understand the difference between residential and commercial. Residential is single-family houses, townhouses, condos, and multifamily 4 units and below. Everything else is commercial. Everything. So that includes office, retails, hotels, hospitality, industrial, mixed use, multifamily, land, self-storage, and special purpose. Those are kind of your general commercial categories. What happens when you go and buy a commercial property? Okay, you go buy a strip mall. You can take ownership in various types. You can take direct ownership. So I could go buy it as Anton Stentner. I could buy it as Anton Stentner just inside of XYZ LLC. We could do it as a partnership where Benji and Anton own a 100-unit apartment building as XYZ LLC. REITs, Real Estate Investment Trusts, those are big commercial property owners across the U.S. They allow lots of people to invest inside of them. What you do is you put your money in, it's locked up for a period of time, and the REIT goes and buys performing assets. REITs are notorious for buying large apartment complexes, malls, large office buildings, things like that. There's also insurance companies and pension funds who will go buy large commercial buildings for the performance. There's your general funds where you're going to go invest in a real estate fund, and the real estate fund may be the industrial real estate fund, and that only invests in real estate, and they're kind of give you a guidance on returns. Last but not least, there are syndications, and syndications is where for a specific property, a general partner gathers a bunch of limited partners, aka investors, and then goes and finds them. So we do actually all of these except for REITs. We do funds, we do syndications, we do partnerships. So happy to chat with you guys more about investing opportunities. But like in general, how does a commercial asset make money? A commercial asset makes money through it being leased out or rented. So if you think of the little strip mall with the teriyaki place, and it's got the nail salon, and it's got a little mailbox place, and it's little 3 stores, all 3 of those little stores are rented. They pay rent on a monthly basis for their lease, and that money then comes to the landlord. So when you go purchase a commercial asset, what you're thinking about, okay, what type of reward could I get for purchasing this asset class? So generally speaking, the one everyone wants, and this is why it's the first one on the list, income generation. We buy it for cash flow, okay? And that, once again, is coming in through the rent or the leasing of that particular property. Now realize land is part of this. So sometimes land is leased, or sometimes land is for agricultural purposes, such as timberland. So there may not be a monthly lease, or if it's farmland, there could be a monthly lease. Or if it's a development project, there's probably no income and you're just burning it until you get to the end. The next thing that most investors are looking for inside of this asset class is what's called capital appreciation. Investors know that generally speaking, the real estate asset is going to go up in value over time. So the capital appreciation is the appreciation of the real estate asset. This is one of my favorite ones, is the tax write-offs through the depreciating of the asset. And then a lot of people, especially right now, are talking about real estate assets as a possible hedge against inflation. And that's historically been one of the things that they've done. Now let's go into just real quickly, what are the risks? Okay, the risks associated with commercial real estate is they're generally larger, more expensive buildings or projects. So they're called illiquid. And commercial real estate is sometimes just referred to as CRE. So they say CRE is a relatively illiquid asset. In other words, it takes time to sell. So if you have a stock, you can go to the stock market. I can open my app, I can press a button, and boom, it sells instantly. And I could transfer out of that brokerage account, and I could have the money in max 3 days. If I go to sell a residential piece of real estate, that's probably going to take me 2 weeks to 30 days to sell it, and then I'm going to get paid 30 days later. So I can have the money in 2 months, maybe 3. A commercial asset, because they're so much more expensive and the due diligence is done at such a higher level, a commercial asset will take you anywhere between 1 to 6 months to sell. Then it takes that borrower 60 to 90 days to close on the loan. So if I want to sell my large office building today, I'm probably getting paid in as short of time as 5 months to as long as a year from now.
A year, wow.
Also, vacancy can be a problem. See, when I own a simple duplex, it's easy to operate. If you own a large strip mall with an anchor tenant, and the anchor tenant is Whole Foods, and Whole Foods moves out, it's going to take you a year, 2 years, 3 years to replace that. So part of commercial real estate is being able to weather these larger storms. Commercial real estate, just like residential, is leveraged, but the numbers are bigger. So you take a home here in Marysville, and let's just say, it's a $750,000 home, and maybe you've got $600,000 worth of leverage against it. A commercial asset is going to be like a $3 million asset, and you're going to have $2.2 million worth of debt against it. So the leverage just becomes more risk because the numbers are bigger.
Can I ask a question?
Yes, please.
So I had this question a little bit earlier. What percentage of commercial real estate in general, when purchased, is done leveraged versus all cash?
Oh, that's a great question. More commercial real estate is purchased with cash than traditional real estate.
And what do you think the percentage is if you had a range?
It's probably in the 20 to 30% range, and it's going to depend on the market.
20 to 30% is bought in cash?
In cash.
Oh, got it. So that's a pretty big number.
It's a big number.
Oh, okay. More than residential.
Residential is usually around 15 to
got
17.
it. The reason I ask is because I'm sure we're going to get into kind of like what's potentially going to happen. If that number is lower and more leverage, that you're talking that 22 trillion you talked about, it can really kind of topple down and have a domino effect.
Well, if there's 22 trillion worth of assets, and let's just say 70%, so 15 trillion of that, give or take some math right there. That was Arlington math, by the way, has debt on it. And that debt is coming due over the next 2 years, that's going to be a problem. So most of these commercial assets are also held over longer time periods. You don't go flip an office building generally. These purchases are more like 5 to 10 year runs, especially when you're doing partnerships and syndications and things of that nature. What's very interesting about CRE is there's generally a low correlation between the stock market, interest rates, and the value of CRE. So commercial real estate is its own market and will buck the trend of what's happening. So that's another reason people love this just asset class in general. They can put stuff in bonds, they can put stuff in the stock market, and they can put stuff into commercial real estate, and it gives them that diversification. The other thing, and we've kind of already mentioned this, but we need to really make it clear, is because the assets are more expensive, it has a much larger down payment, which creates a higher barrier to entry. So commercial real estate is owned by fewer individuals as a whole, and that's why it's owned more in partnerships, in groups, in syndications, and real estate investment trusts.
Well, owners generally, especially if they aren't using as much leverage and are part of syndications or big investment portfolios, have more money. So they're more well off. We talked about the David Sachs guy who he's just like, yeah, I'll just cut a check so that we weather this storm. Or like, I'll just get it off my books or whatever. We're the average American, right? Because we're here in the States. When it comes to their residential home or a rental, they couldn't just do that.
Bingo.
So that's why, again, and I know I keep wanting to hear what's going to happen, but if commercial gets affected to the point where these people who have money are starting to get into trouble, then we're all potentially in trouble.
Then hopefully the tsunami warning sirens are going off and we're swimming for the shore.
Papa Powell's a superstar again.
Papa Powell's the superstar. So what we've got to get into next is how does the valuation of CRE happen? What creates the value of commercial real estate? So what creates the value in commercial real estate is what's known as the net operating income of the asset. And I'm actually going to read a definition. Net operating income, this is the income generated by the property after deducting the operational expenses like property taxes, insurance, maintenance costs, but before, and this is the key one, always people have to remember, financing costs such as mortgage interest. Another thing you always have to take into consideration is the current market value. That's the estimated price of what we could sell it for today. Because what this does is this allows us to now talk about cap rate. So the cap rate is the key metric that's used in commercial real estate to estimate your potential return or your ROI for a property. It gives people a quick way to just make a quick glance to see if, this is an asset I would consider looking at. It reflects that relationship between the net operating income and the market value. A cap rate, what it does is it essentially tells you what's my return or my annual return that I can expect to receive on my investment in this asset expressed as a percentage. So the formula for a cap rate is cap rate equals the net operating income divided by the market value. Now, if you don't know the market value, you make that one up. Or if you're going to repair the property or do a value add, you assume the finished value there, because you can have a starting cap rate and a finishing cap rate in something like a multifamily value add. So we're going to do some math. So I need you to math with me.
Arlington math?
Nope,
Or
this
like
is real math.
Okay, good.
Yeah, this is good math.
Just make sure. I'm still trying to figure out if 15 is 70% of 22. Because I'm from Marysville.
Okay, so in this example, let's assume the net operating income is $100,000 and the current market value of the property is $1 million. So cap rate equals net operating income divided by market value. So to figure out the cap rate, we take the $100,000, we then divide it by the million, which gives us 0.1. And then in this case, 0.1 is, of course, 10%, times it by 100. So this means that if an investor purchased this property and it was providing, regardless of debt, and it was providing $100,000 a year in net operating income, that this would be a 10% cap rate.
That's pretty good.
This would be a phenomenal deal. We would buy this all day, every day, and investors would throw money at this like crazy. Let's go to reality. Okay, this is what's actually happening here in the Seattle Metro. These are real numbers. An example cap rate in our metro used to be, for that same commercial asset, was probably a 4 cap, as debt was really cheap over the last few years.
So 4%.
4%.
Yep.
So you would take your $100,000 and now divide that by 0.04, which would give us a market value of $2.5 million. So notice how geography and cap rate really weighs in. Because see, debt was cheap, and so there's the frenzy, which causes lending criteria to relax, which force these cap rates down below their historical norms. That's why we talked about 4. And now interest rates have come up. Thank you, Papa Pal. You raised them as fast as humanly possible. So now we're at about an average of a 5.5 cap throughout the Seattle Metro. Let's say our net operating income didn't change. So you take your $100,000 divided by 0.05, which gets us 1,818,000. So you just lost almost 700 grand in 2 years in the value of your property here in the Seattle Metro. This is the same all across the U.S. because cap rates have risen everywhere. One of the problems we're going to discuss further. You have to continue to get to the next part. And what's beautiful is we now have video games with the save and continue. It's not like Super Mario Brothers. When you just died, it was over. You had to just play better. So you can skip forward, skip back if you need to.
You totally lost me first thing. I was like, are we talking about real estate? Or
We're talking about real estate.
Did you have a moment there where you remember your Nintendo session? I was like, no, I'm totally lost. Okay, got it.
We can skip forward and back now in life, in video games, and look at where we're going. I'm just saying when we were kids, things were harder and we went to be able to figure this out.
Can I add one more curveball to this?
Yeah.
And you might be going towards this direction, but when I see this cap rate, 5.5, and you have to adjust it, and so the overall value becomes 1.81 million versus the 2.5 million, and that means you've lost over almost $1 million in value.
700, yeah.
$700,000. But then what happens when the net operating income goes down because of what's happening in real estate right now, especially in commercial?
And what would cause net operating income to go down?
People leaving commercial because, remote work is the big one right now.
Occupancy. So you're nailing it.
Yeah. So occupancy for different reasons, you're saying.
Yeah.
Right.
So like if your occupancy rate went down, so in other words, you had a higher vacancy. So if it's an office building, and there's some numbers later in here, but we'll give you a spoiler. Some office buildings are experiencing a 20% vacancy rate, which is at like almost back to its ultimate historic high right now. But increase in vacancy, inflation. So remember, it's net operating income. So if the expenses go up, your net operating income goes down. You hope the rent went up, Some did, but also some didn't.
And then competition.
And then competition. Next major piece of financial information that commercial assets are based on is what's called a debt service coverage ratio. This is one of those crucial metrics in commercial real estate that expresses the real estate's ability to cover its annual debt payments. So what it is they look at the net operating income and they divide it by the debt service. And that gives you your debt service coverage ratio. So if you had $125,000 in net operating income and you had $100,000 a year debt service, your debt service coverage ratio would be 1.25. But as you said, if that net operating income goes down, then that debt service coverage ratio goes down. Debt service coverage ratios are generally covenants inside of your existing loan and generally covenants in order for you to refinance. Debt service coverage ratios were at like 1.15, 1.2. They are all 1.25 or higher right now. So these buildings have to have higher net operating income, but if their expenses went up from inflation and the rents didn't go up, that means they have to cash in refi to keep these assets moving. So
Cash in refi being they actually have to bring cash.
not a cash out refi like we really where you take cash out. You have to reach into your pocket and hopefully you're like David Sachs and you can pull money out of the pocket in order to be able to give the bank.
To just keep it going.
To keep the asset.
Wow.
Otherwise, they'll call the note due. A higher debt service coverage ratio indicates a healthier financial situation for the property, as it signifies a greater buffer to cover its debt and its obligations. Generally, a DSCR above 1.25 is considered acceptable for most lenders, while as a DSCR above 2 is seen as like the most secure assets. Okay, on to the next. So one of the factors that they're always going to look at, and we just mentioned this, is that debt service coverage ratio and determine your eligibility, or if they're going to extend the loan, or if they're going to even originate it to you. Does this make sense?
Totally, yeah.
Okay, on to the next one. What has the Federal Reserve done to commercial real estate by raising rates so rapidly? So when Papa Powell lifted us 550 basis points from zero, and if you think about it, that is the proverbial hockey stick, is we got to once again kind of recap the commercial real estate market. The commercial real estate market has dropped 11% since the Fed started hiking, according to a recent article by the IMF. REIT estimates that the U.S. commercial real estate market is $22 trillion, and that this is slightly smaller than the whole U.S. economy at $25.5 trillion. And then Mordor Intelligence, they believe that the U.S. commercial market generates $1.62 trillion a year just in revenue. So this is such a huge part of our economy. So then what is the impact right now what's happening to commercial real estate because of these higher borrowing costs? As these borrowing costs have increased, it's become more expensive to purchase and operate a commercial asset. And just think about it. If you're going to go get debt on $1 million and it's 3%, and you go get debt on $1 million and it's 6%, it's going to cost more. Also, we know inflation has made these operating expenses of all these commercial assets more. Lastly, we know that insurance, because insurance is a major lagging indicator. What happens is insurance prices and costs go up, and it's retroactive. They increase the bills the next year. So the large increases in insurance that homeowners, auto owners and commercial real estate owners have been seeing is from the inflation we actually experienced last year. And it shows up in 2023 and in 2024. That's why all of a sudden people's insurances are jumping 20%. Well, a significant increase in your expenses, labor, taxes, insurance, maintenance expenses to a commercial asset massively diminishes the value because it changes the net operating income, which in turn affects the cap rate.
I just thought of a fourth factor too that's going to lower the value. Well, if there's just less demand, so more competition, but then also less demand, which I guess it's one and the same thing.
Yes.
But investors are looking at these numbers, of course, cap rate ultimately, the easiest thing to look at. They're like, oh, I don't know about that. And this is why, well, I don't know if the treasury numbers are still strong. Remember at one point it was 5%. Is it still there?
We went 5, and then we went below 4.
Yeah.
And then over the last, 2 weeks, it's creeped back up over 4. So we're heading into, 2 reports this week, and one of them's PCE.
Yeah.
And so it's floated up like it's worried about what's going to happen. The news will come out and it'll float back down a little bit.
So highly likely it's going to go back down.
I would bet that we will trend lower for the rest of the year. Yes, based on the totality of the data.
But okay, on that note though, this is another factor, and maybe you're going to talk about it, but so much of the money that would have gone to commercial is being put into conservative assets.
100%.
Like the treasury, because it's
Yes.
at 5%. Because I mean,
Yes.
these numbers, you're just kind of making them up. But if they're anywhere close, then it's like, why even risk it?
Bingo.
Because if it gets worse,
Yes.
then you're talking, there's a lot more risk,
Yes.
and you could be coming up with money versus making money. Because at this point, it's just like betting on the fastest, not even the fastest, the most reliable horse that'll get over the finish line versus the horse that could just topple over, which right now is looking like it could be commercial.
Story time.
Yeah.
One of our large investors who does like 80 to 120 unit apartment complexes. In mid 2023, last year, I said to him, hey, do you want to buy another piece of land? Should we go buy another asset? What are we thinking? And he said, why would I want to deal with tenants, toilets, sinks, hot water tanks right now and get a 5 cap, 4.5, maybe a 6 if I'm lucky, when I can deal with none of that and shove it into a treasury or a high yield savings account and make 5%? And I said, Roger that, but I know you'll be back. He's like, I'm totally going to be back. He's like, but I'm just moving to the sideline for a second. And, once we see where the chips are going, he said, then we're coming back. So that's just one. You hit bullet point number 2, so you're brilliant. Bullet point number 3. If this is happening, this increased borrowing costs, the next thing it does is it slows down development projects, which prevents the future development of office, retail, but I want to go into one specific, multifamily. Multifamily is on such a long time horizon, and actually most commercial assets are. They take about 3 years to get to market. So everything you're seeing that's still coming out of the ground right now had been started 3 years ago. Well, not many are starting today. And so what that means is you're going to have a hole in that multifamily market, which is going to create an opportunity for increased rents due to lack of supply in 25 and 26. It's literally clear as day. This next point I did not expect. I didn't know this. This blew my mind, and I'm glad. So I went down the proverbial rabbit hole. I was like, oh, I'm going to prepare like an hour or two. No, I went for like 5 hours reading about this because I got so excited. So this current decline in commercial real estate prices during a U.S. monetary policy cycle of tightening is actually rare. This isn't normal. And it's like striking how much different it is than previous cycles. So in the 2004 to 2006 cycle, we actually saw the biggest increase in commercial prices during a tightening cycle. In 2005 to 2019, while they were slightly tightening, still cycled up. In the mid 70s, up a little bit. Late 90s, up a little bit. Late 60s, flat. Mid 90s, flat. Okay, 1977 to 1981, up a little bit, down a little bit, just hovered around. But remember, that was during that massive inflation. 88 to 89, down. 83 to 84, down. 22 to 23, down by a magnitude of order double, 2x, what we had seen in any previous monetary policy tightening cycle. That's what's interesting. So The Fed is looking at this. This is why I said if you need to go review that, go to episode 46, go to episode 44 and review what we've kind of already talked about in those podcasts. The Fed is seeing this and they said, wait a second, this is the most it's ever dropped. Why? Because when we joke about how the Fed broke housing, the Fed also broke commercial real estate with cheap 0% Fed funds rate, kept commercial debt at anywhere between 2.5% to 4% for too long, which caused a lot of speculation, which caused easy money, which caused the TikTok syndicators to come out of the woodwork, people who should have never been putting together syndications because money's raining from the heavens. And so the Federal Reserve is taking some of this back right now and deflating part of this bubble. This is a good thing if they can do it controlled. Because you know how they have this thing in dealing with forest fires and land management. It's called a controlled burn. But do some controlled burns get out of control and then literally light the field or the forest on fire?
Mm-hmm.
The Fed is hoping to stick the soft landing, but this is the proverbial controlled burn, and this is the strongest we've ever had it.
Another thing, when you look at this chart, and we should show the visual of this, is it's getting faster and faster.
Yes.
You know, like these extreme moves. And if you just think about commercial, why commercial in history wasn't as big of a problem is because it was a little bit more conservative because it just moved slower.
And there wasn't as many in the last 20 years. Now, since the 80s, in the late 70s and early 80s, thank you, BlackRock. BlackRock started coming out with their ETFs, and we started coming out with mutual funds.
What year?
Late 70s, early 80s. I'd have to go do the research. And Wall Street started inventing these exotic products. And these exotic products led to mortgage-backed securities, which has led to the commoditization of commercial real estate assets. And then over the last crazy decade, basically from the Great Recession, 2012 to literally 2022, commercial went on a tear because of those exotic products, because more people could invest easier through different means into commercial real estate. This rapid change in monetary policy is what's causing this stress on this system. What it's also done is it's taken private equity, which is generally a major source of funding. So private equity would also be one of your cash buyers, and started pulling private equity back out because private equity is not investing as much. And then in turn, that's caused rising cap rates and the need for increased debt service coverage ratio. So what's that caused our banks to do? This has caused our banks to tighten lending standards because they see these numbers coming down. And so the banks are going, you know what? If Benji wants to come and buy an asset, we're going to need a lower loan to value. We're going to need more reserves. We're going to need a higher debt service coverage ratio. Oh, and by the way, because you're even though you've paid every loan on time with us for the last 100 years, we're going to increase the spread. So we talked about this before. I was talking to a local community bank, and over the last year and a half, here is what has happened. Generally speaking, their commercial debt was the 5-year Des Moines FHLB plus 1.5. 1 if you were their golden borrower, 1.5 if you were the okay borrower. All of a sudden, the Fed starts raising rate, that's 2. 6 months later, it's plus 2.5. Talked to them a month ago, it's plus 3. For some borrowers who don't have deposits with them in a relationship, if you're an outside borrower coming to that bank today, it's plus 3.5. Unless you bring significant deposits. I said, what's significant deposits? Oh, we'd need to see 400 grand, at least. So wait a second. In order for you to give me a loan and give me a slightly better interest rate, you need my cash to buoy up your balance sheet because of this potential risk that's blooming in the background. Now, once again, we're talking about potential risk. This is the potential tsunami. This is not a guaranteed because you don't know which way the chips are going to fall. But this is also a event that creates opportunity. The last thing that we'll talk about in this segment right here is this idea that the pandemic has changed the face of commercial real estate forever. Because what it did was it started work from home. People no longer had to go into the office, which is changing that downtown metro. And e-commerce and Amazon has changed the need to go to the store to buy something. You know, we can have it delivered in one day. Lastly, and we've hit this, but I've got to nail this one more time. The rising cost due to high inflation is hampering not only the construction, but the maintenance of these commercial assets because it's eating into their net operating income. So it costs more to maintain them. It also costs more to build them, which is eating into the net operating income, and your debt servicing is higher. No wonder commercial is taking a slight dip. Actually, it's a big dip. In some markets, it hasn't taken much of a dip at all or none. So when we say down 11%, that's the nation. Realize there are some markets that are still up and some that are flat.
So what's going on with this $1.2 trillion commercial real estate tsunami?
The tsunami. So this is the big problem that I need everyone to pay attention to. And so the quick review of the commercial real estate market here in the U.S. is basically it's nosedived 11% since the Fed started raising rates. And according to REIT, which is the National Association of Real Estate Investment Trusts, they estimate the size of the U.S. commercial real estate market to be $22 trillion. That's just slightly smaller than our whole U.S. GDP. Our whole U.S. GDP in 2022 was estimated to be $25.5 trillion. And then Mordor Intelligence estimates that this commercial market is going to kick out last year, $1.62 trillion in revenue. So when we're talking about the commercial market and $1.2 trillion worth of commercial debt coming due over the next 2 years, realize this commercial market is as large as the whole U.S. economy on a yearly cycle. That's why we can't let this become a problem. If this becomes a systemic problem, it'll make the Great Recession look like a walk in the park. Remember, the Great Recession was caused by residential real estate, which is a much smaller market than commercial real estate.
What do you think it is? Like, just for comparison, Google it.
We're going to Google it.
Google neutrally.
Hey, Google, what is the size of the U.S. real estate market?
Oh, neutrally's got it. He can even pull it up on screen too. Okay, so he's got it pulled up right there.
100. Oh, hold on. I think residential's bigger.
Well, it depends on what metric, right? And how it's looking.
Yeah,
Well, 3.69, that's not as big as 25.
22.
So it's
smaller.
way smaller.
Yeah.
So the reason I asked that question is because if residential is so much smaller than commercial, and we were affected in the way we were in 2008, who knows what could happen this time with commercial.
It's 20%, ghetto rough math.
Yeah.
The size of the commercial market.
I have one more that I just thought. Back to something you said a little earlier, the reason that things escalated and got extreme, and basically the velocity of change and the velocity of the drop in prices or the rise in prices getting worse and worse is because of the ETFs, because of what Wall Street did to commoditize real estate in general. And if you think about what happened in 2008, that's exactly what happened that led to the Great Recession. They commoditized it. They had this bad debt that turned into worse debt, that turned into basically trash, but no one was really paying attention or saying anything about it. And then you had basically those people like in the Big Short, right? That was exposing it and kind of having even these small conversations. Commercial real estate is just finally getting to that point, just in a different way. And even if it was a little bit influenced by the pandemic. So I guess what's scary is if what you're saying is true, it very well could happen, even though no one's really talking about it.
Some people are talking about this because it's such a big number, but it makes me believe, and I would bet, that the Fed will lower rates to prevent this from happening. because the numbers are so big. You can't have 1.2 trillion in debt come up and have that start to default, because if that whole US commercial market starts to turn, it takes the whole globe down. Because if ours is the largest commercial real estate market in the world, and if the largest market in the world starts going into the black hole abyss, down the toilet bowl, it'll suck everything else with it. The Fed can't have that happen. Therefore, they lower interest rates. Therefore, and I hate saying this, we could see threes again. You could see 3.5 because of things like this. I don't want that to happen. I want the Fed to stay tighter for longer, but the math says that's a possibility that we could get 3.5 to 4% debt again.
Just those lower interest rates even being entertained kind of goes back to discussions people had about how we'll never leave those interest rates. Remember, they said there's no way they could actually go to 5, 8, and 10%
Yes.
long term, because
Yes.
ultimately there's even bigger debts, government debt.
Yeah.
Oh, I mean, you want to talk about scary?
Yeah.
So we got
Just like
residential.
34 trillion.
So we got residential. Okay, so think about this pattern. Residential, Great Recession. We saw what happens.
Yes.
If this happens in commercial, way bigger, it could be a bigger problem. And they're going to follow the playbook they think worked before. But everyone knows it's kind of also kind of kicking the can down the road, more specifically to what? Government debt, which is even bigger,
Money.
right? And
Yep.
you even said one of the reasons they can't let too big to fail happen is because we would affect the whole world. Hence why we saved ourselves in 2008 and in a way during the pandemic, and now with commercial.
Yes.
And then what about government debt? And so what if this is the beginning of this is, I wouldn't bet on this because it's like not even conspiracy theory. This is wild because it's going 10 years out. This is the demise of the dollar. I mean, this is reaching, but my point is it's highly likely that commercial debt will experience some turmoil, which would force interest rates down. Couldn't government debt eventually do the same thing?
100% it could. Okay, so you follow the bouncing ball rolling down the hill. That's the analogy. And the analogy is that as the ball bounces and rolls down the hill, it picks up speed. So the government is spending like a bunch of drunken sailors, and they've been spending like drunken sailors since COVID. And if they don't get spending under control, because right now spending is at 115 or 120% of GDP. In other words, we're spending way more than we're taking in a phenomenal economy. So if commercial real estate starts to become a problem, which it appears it's headed so this is the Titanic headed towards the iceberg. We know it's headed that way. You can see it in the math. Then money printer they got to turn it on. Problem when they turn on the money printer, the debt goes up. And if government, politicians in general, can't control that spending, and someone doesn't stand up and make a stand for stopping the drunken sailor spending, then what happens is that spending becomes too much and it's too big of GDP. And then no one buys our debt. And then interest rates rise, and it's just game over. Like you and I, we tried to sell on the way out, and
Let's get that bunker built.
Yeah, we're moving somewhere.
Mm-hmm.
But that's really where this goes to. The current level of taxation is too low for the amount of spending we're doing, and spending is increasing too fast relative to the productivity of the United States. So it's unpopular, but some politician somewhere has to start cutting something from spending. And I'm to the point where, because I see the numbers, just go 1% across the board. 2%. Just make a flat cut to everything. No special favors, no negotiation back and forth. Don't waste a bunch of time. Just go cut 1%. And if that worked, great. Cut another one. And then we can figure it all out. But
they won't be in office very long.
That's the problem. And they won't get reelected. So the upcoming challenges that it's facing is we got the 1.2 trillion of debt that's maturing in 2024 and 25. 25% of that is in the hard hit categories of office and retail. According to Moody's Analytics, the national office vacancy rate right now, as of their last reporting, was 19.2%. in Q3 of 2023, almost at the historic high. The historic high is literally 19.3. So we're 0.1 away from the worst office vacancy rate ever. What this is doing is this is increasing the risk for banks and for those commercial mortgage-backed security instruments that we were just talking about. What that's doing then is this is causing financing costs to rise and actually just surge dramatically, which will increase the losses on commercial real estate. So you have to hit a tipping point here. You can't keep the debt really high and not expect the commercial real estate market to not slide off the other side. So the debt has to come down. The Fed has to lower these rates to buoy up that market. Who are maybe some of the biggest political donors? Are they people who own commercial real estate?
Yes.
And then do maybe politicians themselves be the type of people who would invest in commercial real estate?
Well, Nancy Pelosi's like a mega millionaire.
She's the best stock picker of all time, as far as I can tell. So what this is going to lead to is those low cap rates, increase debt service coverage ratios, which creates that possibility for the cash-in refi. Okay, so I want to go back to the numbers in our example so people have got this in their head again. In the Seattle Metro, we were just at an average of a 4 cap in the area. So if we assume $100,000 in net operating income and you divide it by a 4 cap, so 100,000 divided by 0.04, that means that building was just worth $2.5 million. In 2024, a lot of assets are now trading at a 5.5 cap. So if they had to sell today, or the bank's looking at refinancing them, they're assuming it needs to now operate at a 5.5 cap. So they're going to take that same 100,000. Let's assume their expenses didn't go up, but we know their expenses went up because of inflation. So we know this math is even wrong. Take that 100,000 divided by 0.055, and the asset is worth roughly 1.82 million. So they lost almost 700,000. So when you go to the bank now says, wait a second, we need a higher debt service coverage ratio. And your financing cost is higher. So you might have to bring in on that $2 million asset, you might have to bring in another 10 to 20%. That's 200 to 400 grand. So now if they don't have it, what do they have to do? They've got to sell the asset. They've got to bring on other investors. They have to do something. Who's at the biggest risk? These smaller regional banks hold 5 times more commercial debt than the larger banks, than your Chases, than your Bank of America. So what's Chase doing right now? They're licking their chops and say, come on, Fed, higher for longer, and I'll take the next bank that goes under. Give me your next Silicon Valley bank. I'll take it. The IMF, and I want to read what they said here. In their January 18th report, what they detailed was what's called a doom loop, which creates fear and just exposes people to the pain over and over again. And they warned financial supervisors that they must continue to be vigilant in order to ensure that the commercial sector's issues don't become an economy-wide problem. Quote unquote, rise in delinquencies and default in the sector could restrict lending and trigger a vicious cycle of tighter lending, falling commercial property prices, and losses for financial intermediaries with adverse spillovers to the rest of the economy. I'm not being the doomer when I say this $1.2 trillion problem. If the IMF says, the International Monetary Fund, what they do is they monitor banks all across the world. If they're writing this in their notes and this just came out on January 18th, they're saying, hey boys, hey girls, this is a problem. Please pay attention to this. So if a bank has these assets and they start to default, what does the bank now need?
More money?
Exactly. They need to increase deposits because the Fed is already looking at them and stress testing them. So what do? They lend out less money. And the BTFP, the Bank Term Funding Program, was created to bail out these banks.
That's the one after Silicon Valley Bank?
Bingo. That program ends March. So right now, a bank, if it's experiencing a lack of liquidity, can take their assets and say these assets are worth full market value, And the Federal Reserve, being this special program, will hand them as much money as they say the asset is worth. The problem is after March, this safety net goes away. The Fed, one of their, I don't know if he's a chairman or a president, Barr, in his last talk signaled that the emergency loan program will not be extended. So when this chairman came out and said it, he said, hey, we're not extending that. They also don't say when the BTFP is going to call these notes due. And so are they, when the program ends, is all this bank funding that's been floating in the background, is that due immediately? Or are they going to let it carry on the balance sheet for a year? This could also cause the merger. You know, JP Morgan Chase reach down, grab some more bank.
So basically what you're saying is I need to get my money out of that small bank ETF that I've got.
I
already
think
really down.
I think small banks are going to get pinched even more. I think we're going to see some more mergers. I think it's inevitable. I think this is what the math is saying. So I want to close on a high note on some good stuff. Like, what are the opportunities here? One, assume some small banks are going to get hit. So there may be, this is not financial advice, there may be opportunities to sell that ETF or short some of them, if you want to go do the research to figure out what their portfolio looks like. But as usual, you need to optimize your cash. Cash is king, and a market is uncertain like this. What it's going to do is there will be distressed assets that will pop up, that will need to be purchased quickly, and so you will need cash to deploy them.
Be the bank.
Be the bank. And go find your dear Aunt Tilly and get dear Aunt Tilly and your homie Benji and your other homie over here, you know, Bill, and get them together so that you're ready to purchase some of these assets out of distress. Second, and we've been preaching this one for a while, land development, because we are so far behind on housing and because these financial institutions have tightened so much, when things hit their tightest, you're literally in the bottom of the U. Financial conditions can only loosen from there. Because if they don't prevent this, doesn't matter. Anyway, we're going into Great Recession, Great Financial Crisis number 2, hopefully not a depression, which leads us into new construction, which leads us into affordable housing. Affordable housing in any form, I think it's just going to be a killer opportunity. There's also going to be opportunities for energy efficiency, like upgrades to your existing commercial assets, for tax credits, for eco-minded tenants, for to get increased cash flow, because once again, inflation's hitting everything, so your energy costs are higher. So this might be the time to go look at solar, more energy efficient windows, better HVAC. Multifamily, because that cycle of building a bunch of them has stopped. There's going to be opportunities to purchase multifamily. There's going to be opportunities to build multifamily. There's going to be opportunities for big multifamily that can't refinance their debt. Industrial still looks pretty good and pretty hot. Old industrial's a little beat up. Self-storage still, I think, is going to be a great play. And that's my thoughts on commercial real estate. Like, I'm concerned, but I think the Fed's going to bail us out and pull a punt maneuver again.
In 2025?
I think the Federal Reserve's pulling that punt maneuver later this year because I don't think they can wait that long. When you look at the graph on the IMF that showed how much that was dropping relative to other recessions, and we go back to our $2 million example, how many commercial asset owners could fork $200,000, $400,000 out of their pocket to do a cash-in refi or to get their note back on track?
Especially the ones that you said are from TikTok.
Especially the real estate syndicators from TikTok.
Which is going back to Ninja loans in the 2000s.
Bingo. The Ninja loans of the early 2000s that created that debacle is the cheap commercial real estate and syndications and real estate funds of today. Those are blowing up. That's why, and I forget where it was in Texas, that one syndication blew up and a few thousand units went bye-bye. That huge multifamily one, you can just Google it. That was exactly because of this, because they could no longer sustain the debt service because they bought it at like a 3.5 cap and the expenses were exceeding the cash. So they just said it's over. And then all the investors got wiped out and the bank got handed the keys back. And I don't want that to happen to our people. But on the flip side, so flip that coin over, somebody's going to pick that asset up at a discount.
Yeah, 2011, 12. 50% off.
Someone's going to pick up phenomenal deals, and I want it to be you.
So if you're a billionaire out there, call us. We would love to work with you. And we'd prefer that to be in cash in the bank. So.
And even if you're not the billionaire, but let's like, most of our investors and most of the people we do business with are in $25, $50, $100,000 increments, and they've got their job and they're really good at their W-2 job, or they're a business owner and they're making good money, and they don't have the time to go do all the due diligence, to figure everything out, to go put it into the asset. And they just want to throw money at something and just be like, here, you deal with it. Yeah, we'll deal with it.
What's 15 out of 22? Is that really 70%? Okay.